Hello and welcome. You're watching Business Today TV. I'm Sakshi, Batra, and this is Market Today, a show where we'll help you understand all the latest cues from the D Street in terms of the benchmark index moves, the sectoral action, and all those stocks that are buzzing in trade today, and also what should be your strategy in the markets right now as we are about to end the financial year 2023 and are looking ahead at financial year 2024. Where will you be really making money? What are the opportunities for you in equities? How should you be strategizing your investment positions? All of those coming up in this show, and we will be interacting with an expert as well. But first up, a quick check on how the markets are doing in this morning. Well, we started off another week on a strong note, rather 0.6% of an upside for both the benchmarks, Nifty and the Sensex, and they're trading near the day's high level, 1750 for the Nifty 50. Also, the Sensex hovering 351 points higher at 57,876. Most of the gains really coming in from the pharma pack today. That's leading the index higher, and some gains coming in on the realty pack as well. Those are the two heavyweight movers. In fact, the Nifty realty is now slipped into the red, but it's clearly the pharma index that's the star of the show today. 1.4% uptick, and apart from that, some gains coming in on the IT pack, on FMCG as well. 0.6% of a gain for that one. The metals are higher by about 0.8% odd. Slight gains coming in on the banking space as well, with the Nifty Bank higher by about 0.3%, with all three constituents also up in tandem with the Nifty Bank benchmark index move as well. The broader markets, you're seeing some mixed reaction right there, with the small caps really not participating in the upward momentum in the markets today. In fact, the small cap 100 index is down by about 1%. The mid cap is showing a contrast move with 0.2% higher in today's trading action. The India VIX is slightly up in trade, 1.14% up. 15.1 is the current level at which you're looking at the markets really moving at. When you talk about the market breadth today, it's clearly indicating a shift towards or tilt towards the gainers or the advances, with 38 stocks of the Nifty 50 up in the green with 11 declines right here. The stocks that are higher today are Reliance Industries, heavyweight counters 2244, the current level for Reliance Industries, Hindalco, ONGC, Apollo Hospitals, Sun Pharma. So some of those pharma majors also moving higher in the top gainers list. As far as the losers are concerned, the big lag is coming on the Adani pack today. Adani Ports, Adani Enterprises down in the red today, about 0.5% to 1.5%. M&M, Tata Motors, the auto stock sulking, and the Axis Bank counter that's down by 0.5% among the top major market losers. Let's welcome our guest on the show now. Mr. Siddhartha Khemka joins in. He's the head of retail research at Motilal Oswal Financial Services. Welcome, Siddhartha, and thank you so much for taking the time out. Well, we've started off the last trading week of FY23 higher, but so far, what is your sense? How has your reading been of the markets, the performance we have seen so far, and how should investors be really reading into the beginning of this week? All right, Siddharth, can you hear me now?
I can hear you now, yes.
All right. So basically, my first question to you was that as we begin this last trading week of FY23, what's the sense you're getting as far as the markets go? This again is going to be perhaps a truncated week. So your thoughts on how should investors be approaching this fresh week?
Yeah, so Sakshi, this is a truncated week and more so important because we have the monthly derivatives expiry. We have the global volatility which is continuing for the last several weeks. We saw FIs becoming net sellers in the last 10 out of 11 trading sessions, and they have sold almost 13,500 crores of equities, and that is since the start of the global banking crisis. So I think this week would see elevated volatility. The banking crisis which started in US, we saw that spreading into the European banks as well. Although the good part about the current environment is that the regulators, the government have been very proactive in providing solutions. So be it the Credit Suisse bank getting taken over by UBS, or two banks in US getting merged with a better and stronger bank within weeks of the initial issue. So overall, if you look at the domestic sentiments, that continues to remain a bit volatile. We had the banking, the finance bill being presented in the parliament on Friday. There were certain amendments which the market kind of taken a hit, be it the increase in STT, be it the removal of long-term indexation benefits from the debt mutual funds. So I think that kind of keeps the market on an edge in a volatile environment. The market has been stagnating for a while now, in hovering around that 17,000 mark. So clearly, getting into the monthly expiry with the highest ever FI short positions, I think clearly traders need to be cautious for any pressure on the downside.
Okay, and as we look forward to a new beginning of another financial year, we're just days away from it as well. And of course, like you mentioned, several market uncertainties that the markets have been looking at towards the end of this year as well, and at the beginning of the new year too. Uh, how will investors really create wealth in financial year 2024? And will there be enough opportunities? We've been hearing constant chatter about that the volatile actions, the uncertainties can continue to be an overhang on the markets. But despite all of that, will investors have enough opportunities to make enough money in the markets?
Yes, actually, I think the current situation, the volatility could last for some more time, one maybe 2 3 months. The other concerns being the recessionary expectation in US, Europe, which are the key consuming nations globally, and could impact the economic growth, especially for emerging countries like India. But having said that, volatility may be an enemy of a short-term trader, but it is definitely the friend for long-term investors. Nifty has now, you can say, been consolidating at that 17,000 mark for almost half years. The first time Nifty touched 17,000 was in August 21, and we are still there. And if you look at the valuations, at that point in time, the 1 year forward PE had reached a high of almost 23, 24 times. And now we are started discounting the FY24 earnings, at which at the same 17,000 levels, market is now trading a comfortable 18, 19 times on a 1 year forward PE. So that definitely gives a lot of comfort. If you look at the earnings expectation, FY23, we went into the year with a very high growth base, and we also got impacted with the a sharp rise in commodity, which led to impact on margins. From there, we are entering FY24 with a low base, and also the commodity prices having come down. We have seen crude sharply off its highs, which below $75, which is very comfortable. Commodity base metal prices have come off. Palm oil prices have come down. So all these would lead to improvement in margins as we head into FY24, Q2, Q3 onwards. The other fact is that companies have started taking price hikes, which they were unable to do so earlier. So all in all, put together, we see FY24 being a good year in terms of earnings growth. Based on our expectation, FY23 Nifty earnings is supposed to grow at about 8 to 11 to 12%, but
Sure,
FY24 this earnings
sure. Okay, Siddhartha, I think there is some technical issue in your audio. We'll try and fix that. Meanwhile, I'll just quickly let all our viewers know that, it's the pharma index that's really, taking all our attention today because of the whole host of news flows that have come about in the weekend. So you have Eris Life Sciences that completed acquisition of 9 dermatology brands from Dr. Reddy's Labs, though both of these stocks are, hovering higher in trade today. Of course, when we look at some of the other stocks like Zydus Life Sciences, that's got 3 observations from US FDA for the manufacturing facility in SEZ1 in Ahmedabad. So that's a bit of a kind of concerning news right there. But the stock is up about half odd percent. Talk about Sun Pharma, that has gone to acquire 60% stake in Vivaldis Health and Foods for 143 crores as well. So that stock is up in trade, 1.2% up, 985 is the current level at which is trading at. Overall, when we speak about the kind of Nifty Pharma performance we are seeing today, it's up by 1.5% odd in trade. And of course, we've been seeing that despite the kind of move that we've seen through this year so far, from January until now, in tandem with the benchmark. So the benchmarks have slipped about 5.5–6% odd, and the Nifty Pharma index has also declined as much. But these new developments, will they really mean, for fresh opportunities for all the investors going forward from here, is something we will also get to understand. But just like how we were discussing with Siddharth as well, as to going forward from here, in case equities is on your mind, despite all the volatility and despite all the macroeconomic uncertainties, we do see some opportunities emerging for the market investors as well. Siddharth, we have fixed that audio, I believe. If you could continue, speaking from where you left off.
Yeah, so I was talking about the earnings growth expectation. So for FY23, our estimate suggests that the Nifty earnings would grow in the range of 11 to 12%. But from there, FY24, the earnings growth expectation is much higher at 18 to 20%. That is on the back of A, improvement in overall demand environment, and B, the fall in the commodity prices would lead to improvement in margins, leading to a better and higher earnings growth. Having said that, I think the strategy for investors in FY24 should be to selectively look at two segments. A, to tackle the initial volatility, one needs to look at the defensive bets, uh, and B, to look at the high growth segments in terms of both earnings as well as in terms of the long term visibility. So if you look at the defensive bets, FMCG is a space which have not been doing well for some time now. That is a space where the raw material prices have come off sharply, and we believe that could lead to both the points: improvement in demand outlook and raw material prices should help them report good improvement in earnings. So you can look at the FMCG space to wade through the current volatility. If you want to look at the long-term growth stocks, we expect the banking and financial services sector, despite the higher interest rate environment, to do well on back of steady loan book growth. Credit growth in the industry, in the system, has been pretty strong. NPAs have been pretty less because the cycle has just started. And to top it all, the private capex cycle is now started improving along with the focus of government on the investment side, which should only pick up as we head towards the general election in the early part of next year. So that is one sector that we believe will provide long-term growth. Auto is another pack which is benefiting out of improvement in demand, lower raw material prices, and or price hikes that they have started taking in. Also, the supply chain issues which were there earlier in terms of the semiconductors and chip availability, that has eased off. The penetration of EVs by some of the players have also helped them improve growth. So I think these are the two sectors from a long-term growth perspective that we like, and from a defensive bet, we like FMCG in the current environment.
Okay. How should one play small and mid-cap stocks in FY24?
So I think, given the current volatile environment, these companies will remain a bit weak. Markets will kind of prefer the larger cap names, the market leaders. But I think, as we head towards the second half of FY24, with the flavor coming back in the overall market, mid caps and small caps could start doing well. They have been the major segment which got the hit of raw material prices, because they are not market leaders. They generally don't have the pricing power. So I think as we head into Q1, Q2, gradual accumulation can be done in sectors or stock specific. It will not be a broad-based rally in the mid and small caps.
Okay. After the recent correction, many stocks have actually come down in double digits. How would you advise investors to really avoid falling the catching of the knife?
So I think sticking with quality names is the best way to avoid catching the falling knife. I think the downside of the market, nobody knows. There is the global concerns about the recession in US. The current banking turmoil could lead into a kind of a contagion, which could lead to a global financial issues crisis, which we don't know. So I think it is best be selective in good quality names, and stagger your investments. Don't go as don't buy in one go, and look for days where markets have fallen off sharply. Don't buy
Yeah.
in euphoria market. Buy on days when markets are not doing well, and pace your buying over a period of time.
Right. But overall speaking, for FY24, will equities play a definite role, or will other asset classes really outperform or dominate investors' interests in FY24? What's your sense?
So I think other asset classes, for example, gold has already in India reached new highs. Globally, also it is doing well because of the current environment, which is not very conducive for equity because risk is off the table. If you look at interest rates, they have already gone off, and we are reaching the peak of the interest rate cycle. And from as we look at the end of FY23 calendar, 2023 calendar year, people have now started expecting that by November the Fed could start cutting rates. So I think these two assets could now take a backseat. As I already highlighted, Nifty has been consolidating for almost 1.5 years. We are hit 70,000 in August 21, and we are still there. So now it is time for the Nifty to start performing. Equity markets in India should deliver about 12 to 15% return in FY24 is what is our expectation.
Okay, so in terms of portfolio construction, let's simplify it for all our viewers. Now, those having lump sum money or have planned investments for FY24 starting 1st of April, how much would you advise investors to really allocate to large caps, mid and small caps, and also therefore gold and fixed income assets, or even get an exposure to say US stocks? What would be the kind of portfolio construction one should work with?
So, Sakshi, that would need a wealth manager or a overall portfolio advisor to look at the entire portfolio segment. I would focus mainly on an equity allocation, and and within that, I would suggest that almost 65 to 70% one can allocate towards large cap, another
Okay.
20% towards mid cap, and a small 10% towards small cap. That allocation in the overall equity would help investors in FY24.
All right, understood that. Well, thank you so much, Siddharth, for being with us on the show and discussing with us these insights about how does one really approach investments as we see the beginning of the new financial year coming just days away from us, and how do we get the best of the markets and our investments despite overall market uncertainties and the macro uncertainties we are held with. Thank you so much for being with us. Our market still hovering higher, 350 points uptick for the Sensex, 57,873. That's the level at which it is trading at. The Nifty also hovering higher by 100 odd points. That's 0.6% of an uptick, 1745. So we are near that high point of the day. We'll have to wait and watch to find out whether the markets build on further gains from these levels, or do we stay at these levels or see any kind of profits being taken off the table, because remember, this is again going to be the last trading week, truncated one, and also of the derivatives expiry as well. So just like how Siddharth pointed out, there could be volatility, and one needs to be very, very prepared and cautious with the kind of movements that we are seeing on the markets and the kind of volumes coming in, especially from the FPIs as well. So keep an eye out on that, and we'll continue to update you about how the markets are trading. And for that, you should subscribe to our platform to be able to tap all the movements of the markets. Also continue to engage with us on our other social media platforms like Facebook, Twitter, LinkedIn, and Instagram. Until then, many thanks for tuning in. After Adani Group, Hindenburg's next target is Block Inc., ex-Twitter CEO Jack Dorsey's payment firm. Hindenburg Research has now announced that it holds short positions in Jack Dorsey's payment firm Block Inc. and has also accused the company of $1 billion fraud and misleading the investors as well. The US short sellers report comes 2 months after the explosive allegation